digital capital is appreciating at 45% a year, and over the last 4 years, and financial capital is depreciating at 4% a year.
Yep.
In fiat, this is in USD terms. I guess I'm back to 1900 and I'm in New York, and we just invented electricity. And I'm just pointing out that I think like one day all buildings will be wired with electricity. And you're asking me, are there risks in the wiring of New York City with electricity? And I guess there's going to be some electric fires, right? And there's also going to be a lot of fire insurance to get sold. And there's also going to be electricians, and there's going to be electricians union, and there's going to be a lot of projects, and there's probably going to be a bond, and somebody's going to complain about it. We're going to dig a lot of trenches, right? Because where are those power lines running? And someone's probably going to put a drill, jackhammer through one of the power lines, and stuff's going to happen. And then we're going to fight over whether we burn coal or we run the power line to Niagara Falls. And there's going to be stuff, but I just think there's just a lot of work to be done. We're building out the future. Bitcoin is digital capital. So it's the transformation of financial and physical capital to digital capital. And that's not complicated. That's a very simple idea if you just say it like that. But the implication is it's also driving the digital transformation of the capital markets. So the capital markets are fragmented, right? The bond market trades in Japan at different times than the bonds trading in Germany, and then the bonds trading in Brazil, then the bonds trading in the US. And the equity market, right? Our existing capital markets are built around equity and debt, and there's some derivatives, right? Equity, debt, and derivatives, and they trade 9:30 to 4 Monday through Friday, and they don't trade on the weekends, and they don't trade on holidays. And they're all fragmented, and they're limited in access. So the implication of somebody being able to trade in a capital market in Australia on Saturday and having an impact someone in the United States, 12 hours off on the time zone or something, that's interesting. So a real-time 24/7 global capital market is interesting. And up until now, it has been, again, it was 0.01% of the money in the world, when it was 6,000 or 7,000 a coin. And now it's 0.1% of the money in the world. And so it is a global digital capital market, but it's still de minimis in amount of capital. And so I think that as you see bigger players come into the marketplace and it gets to be 1% of the capital of the world, now you're going to have the tension of the 20th century. The 20th century capital markets, they're fragile. They're limited to a certain set of people. There are very limited settlement options. They're slow. They're not smart. You can't trade Apple stock 100,000 times on a Saturday afternoon, right? So you can't vibrate it at a high frequency. You don't have you can't self-custody. You can't program it, right? So the capital that's in the traditional markets, it's not programmable. It's slow. It's fragile. And the capital in the 21st century, it's going to be smarter, faster, stronger. And so the interesting opportunity is what happens when the investment bankers and the commercial bankers and the money managers realize that digital capital is smarter, faster, stronger, universal, right? Because it has a lot of implications, right? Like there's 50,000 publicly traded companies. And how many of them are capitalized on Bitcoin? How many of them are capitalized on bonds? So 99.99% of the corporate capital is financial capital, which is fragile, fragmented, right? And defective, right? Digital capital is appreciating at 45% a year. and over the last 4 years, and financial capital is depreciating at 4% a year.
Yep.
In fiat, this is in USD terms, right? But, I think that has profound impact on investment banking, right? Like, why wouldn't you go and recapitalize every company? So that's interesting. I think what's also interesting is it's like the same the financial world brags about taking settlement from T plus 5 days. Like in 1970 to 75, it was like T plus 5 days, T plus 5 to 10 days, then T plus 3 days. And it was T plus 2 days as of a year ago. And now we're getting to T plus 1 day. But we're not T plus 1 day. On Friday, it might be from Friday at 4 till Monday at 10 a.m. or something to settle something. So money still moves very slowly, and it has to pass this fragile network of correspondent banks, and anybody can block the move. And you can't program it. Right. So I use this phrase, when you think about digital capital is invisible, right? It's intangible, it's immortal, right? It's indestructible. But while you're working through your bulls, like comparing it to a building, it's all those things. It's musical. And the musical is something to think about, right? Think about a symphony. Think about vibrating the strings of a guitar. Think about, energy, frequency, and vibration. And think about Mozart's or Beethoven's 7th Symphony or Beethoven's 9th Symphony. Think about what happens when you start to vibrate on various frequencies. And literally you hear it and it's beautiful. And then think about how fast you can vibrate a building. And think about how fast you can vibrate $1 billion block of Apple stock. But with digital capital, you can, on the base network, you can move it once an hour. That's actually comparatively high frequency compared to moving gold once a year, right? What, 8,760 hours a year? So 8,760 times faster than the fastest gold. Seems like high frequency. But really, when you put it on a layer 2 network, the real point is if I can settle on the underlying network, then when you put Coinbase against Binance as a counterparty, or you put Block against, set up layer 2 and layer 3 counterparties, they can move the stuff, at 10 kilohertz on the weekend. And now you combine that with high speed trading has been a fixture in certain equity markets, but we've never had high speed global trading. And now we've got AI. And so if you actually created an AI and you said to the AI, I want you to go ahead and scan 100,000 possible counterparties that want to borrow the Bitcoin, assess the risk, and I want you to make the microloans, chop it up, send it to them, then fetch it back and optimize the yield or the risk return on that. I mean, it's quite likely that the AI is not going to make one decision per 3 years. But if you look at most corporations, they pick one custodian, they place their capital with the custodian, and they generate, if you have $10 billion of Apple stock, what do you think your yield is on it when you actually have it at a wirehouse? I mean, most people don't get any yield. For the most part, when's the last time someone paid you a yield on a $1 million block of stock? Occasionally, you could find someone who'll offer you something, but generally, that's not a very competitive market. It's a very slow market. I would suggest to you that 99% of all equity investors have never been delivered any yield on any equity asset that they hold. So back to your question, what's interesting, the formation of the global capital markets, right? Money moving at the speed of light, money vibrating at, 440 vibrations a second, right? Stuff happening smarter, faster, stronger, right? That's interesting to me. And I think that's where the opportunities are, right? If you're trying to make money, how do you make money? Well, you securitize Bitcoin, or you become a banker, an investment banker or a commercial banker of Bitcoin, or you create these radical new products that have Bitcoin embedded in them.
Turn that into a question. Is there any condition by which you think that Bitcoiners who are holding Bitcoin should consider switching into an asset that generates Bitcoin yield like this?
What I think is Bitcoin is the risk-free return for a Bitcoin maximalist. So just start there, right? Bitcoin is the risk-free return. And the question is, do you want to take risk or not? Right? So, and I ask this question, like in my personal life, like we've created the Bitcoin 24 model. The Bitcoin 24 model is based on a lot of your work, Jesse. You'll find we started with your work, and then we created it. We put it in the public domain. And the Bitcoin 24 model, you can go Google it and find it on GitHub. I think 20,000 people have grabbed it, since I tweeted it. And in it, you've got all of the assumptions about the macro environment. You can crank in your own inflation assumptions, your own innovation assumptions, your own monetization and demonetization assumptions about gold and art and real estate and bonds and currency. And then you can put in all your own Bitcoin growth assumptions and create a bull case and a base case and a bear case. And then after that, there are micro models. And so you can model your family and decide, do you want to move to UAE or not? And how much money can you generate and when? And how much assets do you start with? And you're going to, inherit money from your rich aunt and what? And then you could decide, if you can mortgage your house or not mortgage your house. And so you've got a micro model, and it's also got a corporate model. And, if you're a corporation, you can crank in your corporate model. You can also build your own. I mean, it's an open spreadsheet. Just grab the thing, duplicate it, and be off to the races. And you can create a institutional model. Look, the answer is different if you're running Harvard's endowment than if you're running, the Myers Family Trust, than if you're an individual, than if you're a Bitcoin miner, or if you're an operating company, or if you're a bakery, or if you're Tahini Brothers, right? I mean, everybody's got their own thing. So that model is very open, but what I've done is I cranked in my assumptions, and I have presented my base case and in Nashville. And my base case is Bitcoin goes to 13 million a coin, and it's the ARR of 29% ARR over 21 years. The only thing that's better than Bitcoin is more Bitcoin. Okay, so what is my personal idea? My personal view is like my personal holding strategy is I own Bitcoin. I'll either hold the asset, 17,732 Bitcoin, which I tweeted, 4 years ago, which I'm still holding. Or I would hold like the ETF if I needed to, to buy, if I had extra cash flow yesterday and I just wanted to have it. And I thought, well, I don't know if I can hold it for a decade. I might need to spend it in 2 years to pay some expenses, but I'm going to hold it for now. So if I'm trading in high frequency in and out or whatever, it's like, I would buy an ETF of Bitcoin, and I would take the counterparty risk to BlackRock or Fidelity or something. But, would I put my Bitcoin with Celsius, or BlockFi or FTX or Genesis?
Long list.
They all pitched me, by the way. I already said no to every one of them. No. But why? Because the counterparty risk to an unregulated entrepreneurial custodian is like 25% a year. Like they're going to fail every 3 years, right? So, I mean, just rationally thinking, and I just don't need the headache. So if you offered me 40%, I mean, think about this, right? If you thought you've got 25% counterparty risk and your risk-free rate is 29% over 21 years, you're already up to the point where they have to offer you 55% interest to put your money in their custodian, right? So did any of them offer me 55% interest? No. And by the way, if they did, then my next question is, well, how are you going to generate 55% interest? Well, we're going to like put it in a DeFi levered protocol on what? I'm like, okay, well, no. Now I've got like towers of counterparty risk. That's like 7 layers of risk. And eventually there's a degenerate trader, offshore in a dark pool that's levered up 20 to 1 that's paying that. So none of those things are very compelling. So I would say those don't make any sense. But, on the other hand, like if JP Morgan offered me 5% interest on my Bitcoin and they pledged their balance sheet, too big to fail. If they said JP Morgan won't back it, if they said we'll take your Bitcoin, we'll loan it to someone who wants to short it, and if they short it, then you're out. I wouldn't take them as a broker. But if I was facing them as the counterparty, I'm like, I think that the U.S. government will have to fail before J.P. Morgan fails. And so, if it's one of those top 4 too big to fail banks, and they offer me SOFR, and SOFR was 550 basis points, then would I take that yield? Probably, yeah, maybe. Right? I mean, don't hold me to any amount forever, right? But some portion of my assets, I already trust those banks, right? If you don't trust those banks, keep in mind that the U.S. government trusts those banks, right? The entire civilization runs on those banks. Apple, Google, Facebook, all run on, everything else you own is clearing through those banks, right? So you're probably going to starve to death, and the supermarket shelves are going to empty out if those banks stop working.